name's Mark Masson of FD Recruit. So good day, everyone. Huge welcome to what will hopefully be a really informative, relaxed, and enjoyable webinar on fundraising to selling your business, and perhaps very importantly, what you need to know. So I'd like to welcome our expert panelists from BDO. That's Adam Barron, a director in growth advisory, and Lorna Hopkinson, managing director in the M&A area at BDO. So to all those attending, we'd really welcome any questions. Please put these in the chat box. I think Zoom may tell you to email them, but don't do that. Put them in the chat box, and towards the end of the webinar, we'll answer as many as we can. So okay, let's kick off. Let's get started. Thanks very much.
Hi everyone, thank you for joining. Yeah, as Mark said, Lorna and I both work at BDO. If you don't know what BDO are, it depends how you want to frame, but I'm the fifth largest accountancy firm in the country, or if you ask our marketing team, they've put together a good tongue twister, which is the largest entrepreneurially focused accountancy professional service firm in the country. So had to close my eyes and try and do that. So a little bit more about Lorna and I is originally qualified as a lawyer and now qualified accountant. Got a massive passion for fundraising. I am a lifelong suffering Spurs supporter. And when I'm not doing all of that, I've got three young daughters who run absolute rings around me, so kept pretty busy most of the time. And what I do is I set up the team just over 6 years ago now to provide investor lens fundraising support. So I set the team up with a former investor who used to run a fund for over 15 years. And what we both wanted to do, and we met and decided that we wanted to provide real hands-on investor lens support to companies when they're looking for fundraising. And what that basically means is we look at it through the eyes of an investor, so that when an investor does look at the opportunity, it increases the chances of success, because investors see so many opportunities. You really want to stand out and them to go, wow, this company is well prepared. They've come to the right person. This is the type of company I want to invest in. And it just creates a more efficient, hopefully successful process. Lorna?
Hi everyone, I'm Lorna Hopkinson. I am a director in the core M&A team. I'm a retail and consumer specialist, so I've been at BDO a long time, started in the consulting team, have spent significant amount of time within the M&A team now, ultimately advising consumer and retail focused brands and companies looking at fundraising, minority and majority exits, and equally working with private equity and trade companies that are looking to acquire. I've been in-house, so I've been FD within a couple of retailers. But yeah, I suppose day in, day out, spend my life and time working with businesses across the M&A. Don't really have any good football chat, I'll be honest, although I have supported ex-footballers with fundraisers, but not really an avid football supporter, so I'll leave Adam to that. But yeah, great to meet you all, and I look forward to having any questions.
So how we're going to run the sessions, we're just going to go through some slides. We've got quite a lot of information, so I might race through it, but the slides will be shared afterwards, so you can go into a bit more detail. And of course, you can reach out to Lorna and I with any questions you have. And the way that we're going to do it is I'm going to give the fundraising perspective for each area, and then I'll lead Lorna in to give a bit of an explanation as to how that changes if you're selling your business rather than looking to fundraise. So go all the way to basics. When you are reaching out to an investor, they expect to see a couple of pieces of information, not one, like areas of information. So that'll be your financial forecast or your model, which I'll go into what that comprises of. A deck, which is the longer version of all the information that they will need to see to start thinking about where they want to invest in your business. A teaser, which is a shorter version, maybe like 10, 12 pages, absolute maximum, which really summarizes the opportunity. Again, goes into that in a bit more detail, and a data room, which breaks down all the real follow-up information they might be asking for into a bit more detail. With a fundraise, you need to make this as easy as possible for investors to see. They might see up to 4,000 opportunities a year, so you really want them to look at it and put no barriers in front of them. So, for example, hopefully I'm not crossing over to what Lorna's going to say, but when you send out a teaser, it's got to have all the information, the company's name, when it was started, how much you're looking for, all of that. There's no cloaks and daggers, because an investor's going to turn around and say, well, if you can't tell me the name of the company, I'm not going to follow up. Like, I'm investing in the founders. It's a people investment, not just an acquisition. So you've really got to take anything that's hidden out of it. So really upfront, really obvious as to what you want, which is obviously different from M&A. Lorna?
Yeah, so similar, very much similar, but I suppose with a full M&A sales process, you're just looking at a bigger process, probably more sophisticated large trade acquirers or bigger ticket private equity. So it's just slightly nuanced in terms of what you would look for. So probably an integrated P&L cash flow balance sheet, robust, at least 3-year model with the ability to overlay different versions of kind of debt scenarios. You would need a full information memorandum that your advisor would lead you through. So just that it's a more robust version, I suppose, and fuller document than the typical debt you would use in a fundraise. You would often, depending on the scenario, have vendor due diligence documentation, which you wouldn't prepare, but you would appoint somebody to prepare for you. But as part of that process, you would be supplying information to enable the diligence providers to prepare that. And then you'd have a really comprehensive data room, because you would typically, in a full sale, have diligence providers across a whole host of different categories in a way that you often don't see, or you just see light touch in a fundraise. So you would have typically commercial due diligence, IT due diligence, finance due diligence, tax due diligence, but also kind of lots of other iterations of that as well. So increasingly ESG due diligence, IT strategy, management, all these different bits and pieces. So your data room becomes this kind of core working document where you're compiling and sharing information that ultimately then you are referring to through the disclosure process to give protection for the sellers.
I think this is a slide where I really prove the point that we've probably put too much into the deck. So I'm not going to go through each individual point, but as I said, VCs, lower mid-cap PE investors can see up to 4,000 opportunities a year, so they know exactly what they're looking for. And the aim is really they're looking for how big the market is, because if the market is big, then you've got more opportunity to take your small chunk of the market. Will mean that when you exit from when the VC exits from the investment, it's likely to, if you capture 10% of the market, you've probably captured enough of the market to make a nice return for the investors. And then management, and this is what I said before, that like the founders are really, really important. The management team is who the investors are investing in, because the stage of the company, can the management take advantage of that market? And who's behind them in terms of the second layer of management, depending on the stage and size of the company. Profits and cash, really looking into the financials. So this is really from like Series A, Series B stage onwards, the investors are increasingly looking at the numbers. The numbers are really, really important. I'm going to go into the types of things in a financial model that the investors start to look at. But those are types of things that real headline you'll see from any investor. They'll go straight to how much is this company turning over, what's their burn rate, how much are they raising. That's probably one of the first page they look at before all the rest. The platform. So this goes into a little bit more onto whether it's a buy and build opportunity or organic. If it's a buy and build, is the core business that you are going to acquire onto strong enough to support those acquisitions? And if you're not doing an acquisition process, On the organic side, if you're acquiring clients, what is your upsell history? So let's say you are a B2B tech platform, and you've sold one module. Are those clients then buying more modules or adding more users to their plan? And then the positioning, where are you in the market? It's not about, I don't know how many people have seen that your typical like crosshairs competition slide where everyone else is on the left and your company's top right. Everyone says, yeah, my company does everything that no one else does. It's really going into it and saying, what is the problem in the market? Why is your solution the solution? When you're pitching, who do you pitch against and why do you win? Those are the types of things that investors really want to see. And then they might say to you, let me see a sales deck that you send to your clients so I can really get into the shoes of the client and say, yeah, I get it. I understand now why I wouldn't buy from them, I'd buy from you because you are doing something slightly different. Slightly different things when you're selling your business. I'll let Lorna jump in again.
Yeah, so I suppose all of these things resonate when you're going through a bigger sales process. The slight nuance I'd say is who are the likely buyers? So is the likely buyer in your scenario a trade acquirer? If it is a trade acquirer, who are those trade acquirers? What are likely synergies going to be? What's the positioning going to be? What is there a competitive tension you can get because of the market dynamics and thinking that through so that you know how to really drive the value. If private equity in the mix, they will be thinking, what does the ultimate exit landscape look like? Who would be the ultimate trade or private equity acquirers if it was going to be a secondary? And then that therefore should be factored into your thinking when you're positioning through the information memorandum and your kind of conversations of sale.
This is just a slide which I hope could be helpful when the deck is shared. When you're looking at each individual area, when you're building your deck, your teaser, it's just the questions that you need to run through for each slide of why, who, what, where, how, and when, and just make sure that each of those answers or each of those questions are answered on the slide. Because what an investor will do is have a look at a slide, and if they've got a question that you haven't answered, they're very likely to put down your deck or your teaser, go to a meeting, go out for lunch, come back, look at it and go, yeah, I didn't get that. I'm just not picking it up again. It will go in the bin, or they'll delete the email. They are fickle and have low attention spans like that. That's just how it is. So you need to make sure that every page of the deck you're looking at and you're thinking, if you were in their shoes and someone said, let's go out for lunch, you want their answer to be, wait a second, I'm just finishing this deck. It looks really interesting. Or if they're in a rush to get to another meeting, they'll turn around to their PA or shoot out a quick email to say, looks really interesting. Can we have a follow-up call? So you just need to make sure that you keep ticking over in their minds, yes, this looks like an interesting opportunity. So going on to the financial model, again, I'm going to say this a lot, but too much detail on this slide. But what do you really need to see in the financial model? So full P&L, cash flow and balance sheet, probably at an absolute minimum of 3 years going forward, but probably more likely 4 to 5, and at least 3-year historic if the company's got 3 years of trading history. A dynamic assumptions tab, so one tab that breaks down all the assumptions that you've put in that an investor can look at and change those assumptions, and it affects the whole model. No, that's not easy to do, but it is really helpful because an investor will want to look at sensitizing absolutely everything. And if they need you to go back into the model to create a new version for their sensitivity analysis, they're just soaking up so much of your time. If you build it in a way that they can do all the sensitivities just using one tab, that will help you and help them. Putting your clients in pipeline, don't have to put names, but if you can put enough detail that they can turn around and say, all right, that client has grown from giving you X revenue to Y revenue, that's really helpful. And they can see when you look like you're onboarding new clients and how that grows. That helps them to decide if it's a business that is strong enough for them to invest in, but it also helps you to have a really strong discussion on valuation. Because if they're turning around and saying, I'm investing X times revenue, you can say, okay, that's great. Well, as you can see from the model, our revenue ticks up by X amount in December. So we'll base it off that. We'll close in December. We'll close the round in December based off that revenue multiple because we know that we're signing those clients up. Being really sensible and thinking about it in terms of lags. So if you are raising money for sales and marketing teams, your sales team are not going to come in day one and start signing up 20 clients a month. It's going to take longer. You've got onboarding, you've got the sales team getting used to the product and going out to market. So having a real nice lag of building that up. Same with recruitment. You're not going to go in and hire 50 people in the first month of investment. It's just not going to happen. And it really dampens your credibility in the investor's eyes. And a really strong one is making sure the investment ask flows through. So let's say you're asking for 5 million from the investor, make sure there is a cash need in the business of 5 million. Because if you're asking for 5 million and the cash need in the cash flow and the balance sheet is only 1.5, an investor's going to turn around and say, I'm not going to put £5 million into this business because I need to get a return. And if the business only needs 1.5, I'm not going to get a return for the 5 million that I'm putting in. So I'm not just going to take it and put it on the balance sheet if the business doesn't need it to achieve their goals that they're setting out in the 5th year of the model. KPIs they look for, I'm not going to run through every single one of them, but these are real things that you just have a look through to make sure it's a real sense check the investor will go through to make sure, is this business something that can grow, is ticking the boxes. These are quite strong benchmarks that investors really look for. And returns I've put in there, but I think it's going to make more sense when we come on to valuation, but effectively the 5th year of your model. And I know that sounds a bit crazy. What are you going to be doing in 5 years' time? It is a little bit finger in the air, but that profitability in the 5th year will really affect the potential returns an investor thinks they will get out of their investment, and then therefore really make a difference to whether they want to invest in your business or not. Again, that's kind of basing this around real Series A type investors and how they look at things. And that really does switch when you're looking at selling your business because it needs a little bit more maturity, doesn't it, Lorna?
Absolutely. So I suppose the bones of what you're saying, Adam, are the same. But fundamentally, when you're selling your company, it goes without saying, you need a robust, integrated, at least 3-year model, whether you're selling to private equity or trade. The reality is when you're selling, some of the KPIs that Adam's talking through just need to be significantly evolved when you're selling. So, for example, trade acquirers, typically overseas trade acquirers, unless your revenue's at least 20 million, that $1 million, US acquirers won't be looking at a UK business. So you need to be bigger, you need to have strong EBITDA margins, and the story through your plan needs to be really robust so that it can be stress tested in diligence, that your overlay for debt can be built into the model. And fundamentally, if it's a private equity acquirer, they're going to be looking at the returns that they're going to get in 3 years. So it kind of all needs to stack up. So it's just the next step on from some of the things that Adam's talking about.
And just to give you a bit more color as to how they do that returns analysis is when you're looking at the entry valuation. And this is how all VCs do it, and a lot of PE do it as well. They look at the entry valuation. And as I said, they use your model and look at the 4th or 5th year in the model and say, what is the profit there? And they use that profit and use comparables to create your potential exit valuation. And then they can see that if I invest today X amount at X valuation, and then exit in 5 years' time at the valuation that the management team that think that they can get to. So it's not anything, it's on management's case. What is my return going to be? And does that make sense for me? So it's not just, oh yeah, my competitor raised at a valuation of X. It really needs to make sense according to what you think you're going to do in the fourth or fifth year of your business plan. And what is really important is when you're thinking about which investors to go to, what return they're looking for. Because some investors, and this goes for the more mature investors, like the PE investors that Lorna's talking about, will look for 3 to 4 times, because if you've got a business that's already doing 2 or 3 million of profit, that business growing 3 times is pretty impressive. But if you're investing at a much earlier stage, you're taking a much more risk. So the earlier stage that you go, the more of a return investors are seeking, because the more risk they're taking a lot more risk. So what you'll hear a lot of real seed, which is like a few £100,000 of revenue type businesses, when people invest in them, they're looking for an absolute minimum of 10 times. And that's because if they invest in 10 businesses and they put £1 million into each business, the likelihood is at least 7 of the other businesses they invest in will go bust, because they're investing at such an early stage, they're taking so much risk. So in order for them to make a profit on their fund, they need at least 2 of the businesses they invest in to grow 10 times, or to, when they exit, they've made a 10 times return. So the earlier stage and the more risk investors are taking, the higher return they want. So that's just something to think of when you're building out your model and you're looking at what year 5 says in your model before you send it to an investor. Another kind of really high level thing, which I think will be helpful when it comes across, and you read it you pick up the slide deck. It's just a bit of a cheat sheet as to all those phrases that I've probably thrown at you, and half of you probably don't know what seed, Series A, Series B are, because everyone has different explanations for what they are. So I think that this kind of breaks it down into what I mean when what stage focus they are, the common elements of growth at each stage, and really in the UK, how much you can raise at each stage. A bit more on the types of investors that you're going, or you're thinking of going out to. I've seen too many companies that come to me and say, look, I've been out to 1,000 funds, and I haven't said, look, just send me the funds that you've been out to. Let's see if it makes sense. Let's see if I can add any more. Let's see if I can introduce you to some of the funds you haven't had any traction with. And you talk to companies that are doing £1 million of revenue and they're losing £1 million a year, and they're going to funds that quite clearly say on their website, we invest in businesses doing at least £1 million of profit. And you're just wasting your time. You're wasting your time sending an email, even if it's only 10 seconds, send an email, you're really wasting your time, because then you're going to chase them as well. But if you know that you are going to the right types of investors from a stage point of view, there are other things like, will they invest in your sector? So if they won't invest in consumer, lots of investors will turn around and say, we only invest in B2B software. Why are you sending them your consumer opportunity? You're just wasting your time. And then to go into a lot more, things like size of fund matter. If you want an investment now, but you know you're going to want more in 2, 3, 4 years' time, can that investor follow on? Do you want that investor to follow on, or do you want to go for a different type of investor or investment? Culture and chemistry, especially with ESG at the moment, what is their focus and their ability to support you from a cultural fit? And as I said before, investment horizon, exit strategy, how long do they want to hold the investment for, and what return are they looking for? Slightly different for acquirers.
Yeah, it's really different for acquirers, I suppose. So depending on what your options are, so depending on what your sector is, what your subsector is, trade acquirers may or may not be available. So often, typically, people would like a trade acquirer. It's just whether you will be able to have that trade acquirer with your size and positioning. So typically you can get a higher valuation under a trade acquirer, because if there is the right strategic rationale to acquire, they'll be willing to pay a premium depending on the synergies they can get from owning your business. And ultimately, from a seller's perspective, if you're looking for a full exit and walking away almost on day one, this can often be achieved under a trade sale. On a private equity, it will depend on options, sector, appetite for private equity, and as Adam touched on, who's investing in which subsector and which size of business can make a big difference. They really need to see themselves get the return over 3 to 5 years. Family office, we're seeing more and more prevalent actually. They're slightly more patient capital as a type of acquirer, so will often acquire and own businesses, but over a longer period of time. So if you're more of a cash cow business with more steady profitability, actually that might be a good option to explore. There's quite a lot of family money where they're looking to invest in profitable UK businesses, but are more supportive in terms of family and management dynamics given the way they're structured. The interesting thing for private equity and why people do like it is fundamentally you can de-risk yourselves by taking money off as owners of a brand, pay off your mortgages, take some cash on the table and put some cash in the bank, but actually leave some stake in your business. So fundamentally, you could potentially earn a significantly higher sum going forward should the business perform in a way that you'd hope and expect it to do. So there might be a considerable cash sum in the future, depending on the growth. Clearly, the dynamics change if you sell any portion of your business, to be honest, whether that's VC or private equity. Fundamentally, you're going to have someone else around the board table. It impacts the decisions, can impact the dynamics with shareholders, and ultimately, yeah, you've got someone making the decisions alongside you, and it's not just an independent decision.
And one of the questions that I get asked a lot is how long does the process take? And I think when I say 6, 7, 8 months, people think, wow, that's a really long period. But I think this breaks down as to why. If you really break down, think about how long does it take to prepare to go out to market, it's going to take at least 6 to 7 weeks. And then when you go out, it's going to take, you are going to take 4 to 6 weeks speaking to investors. And then once you've chosen the right investor, negotiating term sheets, that could take another 2 weeks. And then investors are going to want 6 to 10 weeks to do their due diligence, which includes doing all the final legal negotiations. So I think that at an absolute push, you might be able to do it in 4 months. But I think what we're seeing a lot more is investors are being more risk averse. I think during 2022, early 2023, they lost a lot of money on businesses they hadn't thought about properly before making investments in and not done the proper due diligence. So they are now worried about when they go to raise their next fund, if they've lost too many investments. One, from a fund point of view, it'd be difficult to raise another, either the same amount or a larger fund. But also from a personal point of view, the investor putting it forward are worried about their own jobs. So if they're turning around and saying, well, in the last 5 years, I've invested in 10 companies, 4 or 5 of them have gone bust. If one more business I put forward goes bust and I invest in goes bust, I'm out of a job here. So they are being a lot more careful about what they invest in, which means the whole marketing preparation due diligence period is just taking a bit longer. So I'd say that 6 months is a good benchmark. Slightly different maybe when you're selling.
Yeah, it's similar. I say it's slightly elongated because our prep phase is probably slightly longer because we need to make sure the information memorandum is really detailed and thorough and robust, and we need to make sure the data room is adequately populated for what it would be quite a significant amount of diligence. And our deal completion timing can be slightly extended depending on who the acquirer is. So we just closed something a couple of weeks ago that went to a listed Japanese buyer, and we needed to wait for a couple of an extra month of board meetings and build in timetable to have documents translated into Japanese. So things like that, which you just can't predict depending until you know who the eventual acquirer will be, you need to factor in. Plus, to be honest, the negotiation phase can take quite a long time because if you've got the opportunity with multiple bidders and you need to have that ongoing dialogue and comms, that can extend things. But equally, I've closed transactions in 6 months. We've closed transactions in much longer than that. in retail and consumer, deals have been taking forever in the last couple of years. So it really does depend on a number of dynamics, but I think 6 to 9 months is a really sensible time frame to be thinking about. But to focus most of your time on thinking about the prep, because the better prepared you are going into any transaction, the more successful and frankly the tighter that process will be.
And then I think this is our final slide. So a lot of the stuff on investors, I've already mentioned before about really getting into their minds about how they're thinking. It just makes things a lot easier for them. NDAs, an example, massive no-go. Fine, have an NDA before they go into the data room, because you've already kind of got them on the hook first. But if you go out to VCs, and they're seeing 4,000 opportunities a year, they're not going to sign 4,000 NDAs. It's just not going to happen. So how can you make it as easy as possible for them? If you want to have a version of your T's on your deck, which just says tech roadmap or tech architecture, confidential, available under NDA, you can do that, but they still need to see the deck, etc., without asking for an NDA. And then I'm going to steal one from Lorna's box as well. Lorna's box as well is I completely agree with it. Having that targeted list of investors and buyers when you go out to them is really helpful. Investors especially like to feel really special. If your advisor messages them people that they know and just says, "Look, we're only going out to 10 investors. This is what we think would be really interesting for you. Would you like a call?" They're much more likely to say yes, but it also saves founders time. But there are things that I won't steal that Lorna can jump in on.
No, you're all good. So I suppose from a core M&A process, before I take any business to market, I want to know who the buyer is. So I want to know who the likely buyers are while we're writing the IM. There's no point, and to be honest, our fees are structured that we won't be successful and we won't earn our fee if we cannot sell your company. So we need to know who we think the buyer is before we even take a client on. So that's really important because it means we don't want to go out to 4,000 people. We want to be going out to a small targeted list. We hate huge lists, and we want them to know why we think they're a buyer. We want to have had the conversations really early on a confidential, no names basis, testing whether we think they're going to acquire. So we know likely valuations, we know what their strategic rationale is, why they're likely to bid, how they want to change, and who the key stakeholders are. We warm them up. So for any that I've got something at the moment actually where private equity is trying to preempt a process, they're really keen on something that we're selling. That's not going to launch until next year. They want early access. Okay, fine. You can have early access. You can either get to where we want to on value or you can't, and you have to fold into the process. So I think giving these people that kind of special treatment can go a long way. I suppose in a difference from fundraising versus M&A, we're going out to trade acquirers predominantly as alongside private equity. And so if you're sharing your confidential information with a competitor, confidentiality is key. We're really discreet, particularly where I work in retail and consumer, the press all over the brands that I'm selling. So confidentiality is really important to us. So we're super discreet. We always have NDAs in place and they won't get access to anything without that. And we're really careful around at what point we share different pieces of information with different parties until we're really sure with a key competitor that they're likely to buy. We wouldn't share any information. But fundamentally, we're trying to understand the drivers to buy, and therefore, depending on whether it's a trade or a private equity acquirer, our role would be to help support you and the management teams getting to the place where the board, in terms of trade acquirers, have got everything they need to get board sign off, or investment committee have got decisions and information they need to ultimately support the transaction for you to close.
And that's it. So very happy to ask any questions you've got. And if you don't want to ask a question on here, if you want to follow up with emails to either myself or Lorna, and we'll be very happy to either respond by email or have a quick follow-up call.
Yeah, no, thanks very much, Adam and Lorna. That was really great. I mean, I'm actually a finance person by background before years in the recruitment search industry, but what really struck me there was the actual real life reality and of actually fundraising and selling and M&A and bring it all into, real life human nature, commercial focus with some great anecdotes of what to do and not to do. Anyway, that fantastic. Put some questions in the chat box, and I'll put these to Adam and Lorna before we close off. So I have a question from Michelle here. Thanks, Michelle. Is there a recommended or preferred data room platform such as Teams, Google, Dropbox, etc.?
I think on the investor side, it's not about the platform, it's about the structure. So making it as easy as possible. I've actually seen loads of early stage companies use Airtable recently. So like Google Docs, anything that you can just split out from like financial, legal, board meetings, anything that they might want to see. The other thing that I've seen quite a lot recently, from an investment point of view, is one thing that goes into the data room is an FAQ page. Because you will get asked the same questions by investors the whole time. And what it does is, one, answer their questions without them having to keep bugging you, but also it puts it into their mind that you are talking to loads of investors, because they're thinking, okay, if these are frequently asked questions, they must be talking to loads of investors, which increases competitive tension, which increases their interest, which increases the valuation.
For that, thanks, Adam, for that. I'm sure there's probably a few more questions coming through, but what would you say were the sort of USPs of what you do versus other advisory firms?
I'll go first. So I think that we are a team of advisors and former investors. So one, it's all we do. So we are living this day to day, and that means we know exactly what the investors want to see. And then we have really strong relationships with investors, so we can go out to those investors and say, look, if there's something wrong with it, what do you need to see? If they're like, if you don't know the investors, they'll turn around and say, I don't like the valuation, I'm out. If you do know the investor, they can call and say, what is the company's valuation expectations? And if you say something that's too high, you can work out with them a solution before they turn around and say, I don't want to play. Because in my opinion, if they are interested in investing in the business, there's always a way to get around the valuation issue. Always, 95% of the time. So I think that those are all the actionable things, but there's also loads of soft things as well. So one of the main things is really giving management bandwidth time back, because I've seen too many times that when companies have been speaking to an investor, towards the end of the process, investors say, well, you're not hitting your forecasts. Why are you not hitting your forecasts? We can't invest if you can't, we can't even trust you during the 3 months we've been speaking to you. And the founder's response 9 times out of 10 is, oh yeah, sorry, I've taken my eye off the business a little bit to concentrate on the fundraise. And the investor can say, well, that's lovely. Come back when you hit your targets, and you'll never hit your targets because you'll never catch up on that lag. So really giving management time to keep doing what they do, because fundraising is effectively a full-time job. So really working in tandem with management on that.
Yeah, that's thanks, Adam, for that. I know it's not an easy area to go, but
I think as you go up in the M&A stream, Mark, I think what really differentiates us is our deep sector expertise. So I've been at BDO for a long time. Over the course of the last 10 years, we've really become sector experts. So we will always route you across the whole of our M&A stream around who is the right person to speak to. And I'll support Adam on consumer and retail fundraisers. He will go to other people for tech. Ultimately, we're very streamlined. I think we're only as good as our track record, and that's what kind of sets us apart, I think.
No, absolutely great. I'm convinced. And I'm sure other people are as well. No, definitely. And also your personalities and what you're saying, it's all very transparent and obvious. Some great questions coming through, which I will now filter through to you. Craig has asked, 3 million turnover, B2B online retailer with 10% EBITDA, small size firm, best place to raise funds. I think Craig's asking where's the best place to raise funds for that sort of company.
Yeah, so I think it's a lot deeper than like the headline figures, because it would be a lot to do with like stage of growth. Um, are there a lot of like growth costs in the business, or is the underlying business a 10% EBITDA business? One of the KPIs that investors will look for is at least 20% EBITDA at maturity. So it depends. That there is also the option of debt at different levels. So I mean, more than happy that if you want to follow up, I'm not an investor, so I'm happy to sign an NDA and have a look at your financial model, and or just have a chat about what your potential options
Yeah.
could be. And if it's not, for example, today, I could turn around and say at these different points in your business journey and your company's life cycle, these different types of investors would be appropriate. Loads of other things that come into consideration, like whether it's EIS or VCT qualifying, etc.
And also, given it is an online B2B online retailer, there might just be some connections we can make, Craig. So if you want to pick up separately, then happy to give some connections that may well help.
That's great. Quite the questions are coming through now, which is fantastic. And Philip's asking, hi, I'm thinking of changing our auditors, accountants, tax advisors, but with us looking to go for investment in the next 12 months, would you recommend not changing to keeping the consistency and support, or do you think it wouldn't have any impact?
It really, to be honest, from my perspective, it really doesn't matter. It's kind of like, why are you changing? If it's because you're growing up in terms of who you need, in terms of broad support, and you want a bigger accountancy firm that can support you in a more robust way, then that's fine. No one really minds if you've changed your auditors, as long as the numbers are right, frankly, and that you can get the relevant quality of data coming through the investment process. So I wouldn't worry about it. I just make sure that you've got a suitable auditor and accountant that can support you along your growth journey.
Yeah, and just depending on what size your business is when you're looking for investment, it is likely that if your business is slightly more mature, if PE are investing into your business, they'll want a slightly larger firm doing your audit anyway. So if you're already ahead of the game there, it just means you won't. That's one less thing to worry about once the investment comes in.
Great, thanks. Hope that was helpful, Philip. Toby is asking, how would you handle areas like customer or supplier concentration, i.e. upfront, and how is it mitigated, or wait for the questions to be asked? I'm considering the impact of differences in expectations between HOT and DD. Does that make sense?
Yeah.
Yeah.
So I would, depending on how bad the concentration is, but I'm a firm believer in giving as much information up front as possible. They're going to find out anyway.
Correct.
So if it's something that they don't like and you don't have an answer for, a solution for, you are just wasting everyone's time by hiding it. Even if you sign a term sheet and manage to pull the wool over their eyes, it's going to come out in financial diligence, legal due diligence. The investment won't go through if it's something that that doesn't appeal to them. So it depends on how bad that concentration is. I think anything more than 30% starts to get them worried from one customer from a supplier point of view. I don't think the supply isn't as big an issue as long as there are potential other suppliers you could use. So by saying that we're using this one at the moment, but it's an arm's length agreement, and there's these other two or three potential suppliers that we've spoken to and we could switch to if we need to. But from a customer point of view, if you've got 50-60% customer concentration, I think the best way to deal with that is to only really go for investment when you've got a potential new customer coming on board who is going to dilute that down to it nearer to 30%.
Yeah. And equally, if it's a sale process, concentration can actually be a really good thing. You might be supplying someone that they're desperate to supply. So I think it does depend on the dynamics. I've got something at the moment actually that's got a really high customer concentration. Definitely won't be a private equity process, like the private equity is turned off by that. But from a trade perspective, they've got an amazing account with a particular retailer. They've got others as well, but it's just grown hugely. Actually, we're working through what the maintainable looks like because there's new accounts coming all the time. So I think it is how you present it. But I agree with Adam, like, being open and upfront about these sorts of things is the right thing to do.
Great. Thanks for that. Answering that. Really interesting. Dan, I think we'll probably close on this one. It's the end of the questions so far. So Dan is saying thanks for the info, folks, which is I'm sure that's a pleasure. Dan, can you tell me what your fee structure looks like? Is it always success-based, or do you ask for upfront consideration? I'm working with a number of businesses, and some may be able to pay upfront, and others may not.
So I think both of us are mainly success fee based. The slight difficulty for companies that we work for is, as you say, companies don't have the money to pay an upfront fee. So it depends. If a company has very, very little in way of prepared documents or financial model or anything, which I hope isn't true, considering most of the people on this call, that the companies that you're working with, that we might have to charge a retainer, but I think our retainers are a maximum of a one-off fee of 15K, but understand that could still be quite a lot for a company that's losing money. And then afterwards, it's mainly success fee based. We don't hide from a fundraising point of view what we kind of charge, something along the lines of 5% for the first 4 million raised, and then 3.5% after that. But that's if we're running a whole process. We can be really entrepreneurial in terms of doing parts of the process for you, whether that's negotiating the commercials on a term sheet, hand-holding through due diligence, whatever you might need. We can do a time materials there. We can do a success-based time materials, like a 30% up, 30% down. So can be quite entrepreneurial, but I think it's slightly different on the M&A side.
Yeah, I mean, we're working for bigger companies. It's much more involved in terms of what our role is. Like, we genuinely are like a hands-on, very much integrated into your team advisor. And so we always have an upfront fee. We can't do anything that's just success fee based from a core M&A perspective. And then we have a success fee plus a ratchet on top of that. We have a ratchet against an agreed value so that we're all incentivized to drive value for the sellers. Our fees can be sizable, but hopefully we end up with a result that everyone's happy. And fundamentally, we won't be successful unless we get everyone good value. So that's how our fees work. And delighted to chat through any opportunities as and when they come through. Or if anyone wants to chat through anything specifically, then just let us know.
Thanks very much again, Adam and Lorna. Dan, I hope that sort of throws good light on that. And Simon is just saying, will the slides be shared after the meeting? My colleague Christian.
As long as you promise not to criticize the slightly not amazing design of the slides, then yeah, of course.
I like the last slide personally.
I was going to say that was not my design.
It's not very BDO brand.
No, I'm having anxiety around the slide designs from
It's very retro. Anyway, we could have a whole discussion about that. So no, that was fantastic. So as just literally a minute in closing here. So as we bring things to a close, I'd like to thank Adam and Lorna for making this really such a great session. I'd also like to obviously very much thank you all for attending, contributing some absolutely great questions, which really gave good insight to everything more, given the answers. So I hope you all got something out of it. Do as we've said, and as Adam and Lorna said, feel free to make contact with Adam and Lorna about your businesses or any inquiries. Uh, do let us know any feedback on today, and your thoughts are always really welcome. You will get an email after this event with a link to a post on LinkedIn where you can comment if you wish. As an aside, we've also got a sort of peer-to-peer community platform called Eugenie, Ugenie, where you can peer-to-peer question, help, advise, etc. And that the details of that will be in the email. We used to have something called guilds, but that's now changed to this. So look, hopefully we'll interact with you on something one way or another with FD Recruit in due course. We've got ongoing webinars, perhaps see you in another one. And obviously we specialize in recruiting senior finance individuals, finance directors and CFOs. So look, have a great day and thank you again.